Well, there has been a significant disinflation this year of a lot of those shipping prices, and a lot of it was demand curtailment, right? So as prices got very high, and as you started to get stimulus being cut off, and as you started to get tighter monetary conditions, it kind of put pressure on the buyers, and that allowed those markets to somewhat more normalize. The concern I have is that I think that a lot of people are kind of looking. It's kind of like a false sense of security, right? So some of those extreme moves were always going to come off, right? Those extreme levels don't just stay there. Eventually they do. High prices are the cure for high prices is the old saying, and so that's played out. I think the longer term thing is the fact that we had multiple decades of globalization. So basically you had a pool of capital, and then you had a number of pools of labor. Let's say China, former Soviet states, that kind of thing. And the last 3 to 4 decades are basically about tying those two things together, saying, okay, we have capital, you have labor. Let's build factories there. Let's build XYZ there, and then ship it. Let's build infrastructure. And now in a less trustworthy world, in a more multipolar world, we're seeing kind of either a reversal of that trend, or at least like a slowdown and a stoppage of that trend. And that means that more of the cost pressures get pushed back on their own markets. And so I think we're in kind of a more structurally problematic environment for supply chains, where for decades you could ignore resiliency and focus on efficiency because the world was just always getting more and more unified and safer. And now when you can't rely on that fact, when you have to assume what if XYZ happens, what if this country invades that, what if relations between these two countries break down, what happens to my supply chain? You have to bake in more resiliency, and that comes at a cost. And so I think that the longer term story is that we're probably in a somewhat more inflationary environment in that regard, but the extreme edges are taken off because there's not that huge burst. Another thing about COVID is that it in addition to the stimulus and things like that, it also rapidly changed people's behavior in a short period of time, which supply chains are not good at dealing with. So like for a while, everybody stopped flying, and instead they started buying electronics and remodeling their home, right? And so that kind of activity just rapidly changes what people need, and that puts a lot of pressure on those areas. And then there's kind of been a kickback where they say, okay, now we remodeled our home. We're not going to remodel our home for 5 years. We want to go on a lot of flights now, right? And so you have almost like a pullback, and so you have disinflation in some of those goods that were inflated to begin with, and now you have plenty of activity in flying and hotels and things like that. And so I think that as that normalizes, we kind of come back down, but these longer term trends are probably still here. Yeah, so for flights, for example, the supply is not fully back. And it also just ties into the whole rotation I just discussed, where, around the margins, if more people want to do one thing at the same time, let's say buy goods or refurbish their home, that's going to put a lot of pressure there. And everyone says, okay, we did that the last few years. Now we're all going to travel. We're all going to, do things we couldn't do for the past few years, and start ramping up in that regard. There's less international restrictions on travel, which persisted, pretty long in many cases. I mean, back in earlier this year, there were still tons of restrictions that have kind of eased throughout this year. And so as those have eased, basically there's more and more people that are flooding into travel and things like that, while supply, at least for flights and things like that, is still not fully ramped up. And so I think we're going to see probably a similar phenomenon where when we look back, let's say a year from now, 2 years from now, it's hard to say exactly how long it goes, but I think some of these extreme prices will cool off to some extent, because you either get supply coming back online, or those high prices will then deter some people that said, okay, we got some travel out of our system, this is getting really expensive, let's stay home this year, and then the market can normalize. But then I think longer term, the question becomes energy security and gradual deglobalization. Those are, I think, the longer term inflationary drivers, where some of these were shorter term. I think in rate of change terms, yes. When people hear deglobalization, I mean, it depends on what you mean by that, because it could mean that, in the extreme sense, like let's say US and China don't trade anymore. Is that going to come anytime soon? No. But I think it essentially means that you've tapped out a lot of the kind of the easy adjustments, right? Or we've already picked the low-hanging fruit of globalization, which was essentially, going into the 80s, let's say, China was very impoverished and opened up to the world. And so that was like, okay, here's, hundreds of millions of workers. And then there's large pools of capital that said, okay, let's join that. And then you had the fall of the Soviet Union in the early 90s. So you had a number of states there able to open up. And so you had this like basically this huge environment that was just it was just right. It was just ready to come together, and I think a lot of that's already been done. And then now we see, Russia separating, China kind of closing off, more tensions, more kind of tail risks being realized. It's like, what if, again, like what if China does do something with Taiwan? What does that mean for all the U.S. companies and infrastructure there? Does that mean that the U.S. freezes Chinese assets, right? So do they want to hold their assets in the United States the way that they used to? You also have, for example, all the way back in 2013, China announced, when they announced their Belt and Road Initiative, they announced that it's no longer in their best interest to keep accumulating treasuries. So it's not like on day one they just sold all their treasuries, but what they essentially did was they hit a high watermark for how many treasuries they want to hold, and then they're just like flat to down, even though they're still running giant trade surpluses in dollars, and they're just funneling those dollars to other things, which is essentially loans to African countries, South American countries, Southeast Asian countries, all sorts of different projects. And so I do think we see a more multipolar world, and that the low-hanging fruit of globalization is behind us, but it doesn't mean that we backtrack on all of our gains right away. It just means, especially for national security industries, like let's say semiconductors, certain energy things, there's kind of a realignment and kind of a renewed interest in resiliency and kind of backups. So I view us as in a disinflationary cycle within what will probably be an inflationary decade. And that's something that I've been estimating for a while. If anything, it actually came a quarter later than I thought. So if you look at my writings before, I thought that the peak in inflation would come in probably like quarter two of this year, and it kind of dragged on to like quarter three, I think in large part because of Russia. And so they just kind of added fuel to a fire that was already there and extended it a little bit. But essentially, you have, a lot of that stimulus money is wearing off. A lot of that demand destruction, or at least demand slowdown, takes place. And so now we're in kind of this period where central banks are fighting back, fiscal authorities are trying to fight back, trying to gain control of that inflation. And it's working better in some markets than others. And so my overall expectation is that we're in a disinflationary environment. But when we look out at, say, 2024, 2025, I think that's where we risk having another inflationary spike, because the energy situation is still not fundamentally resolved. Basically, by releasing U.S. oil, by China being shut down partially for a while, there's been ways to kind of keep oil from skyrocketing. But if you want to have another cycle of growth ahead, let's say, after we get through 2023, if you go into 2024, you want another cycle of growth. Well, we haven't seen a lot of new energy supply come online, and so that's kind of ready to be a problem all over again.